Good afternoon, everyone. Welcome back to my channel about investing, luxury lifestyle, freedom, wealth. I think I found out what my catchphrase is. I'm call me you guys as a wingman. The reason why is that one, I love chicken wings, I love tacos, so I love wings, and then also call me your wingman for investing because ultimately. Uh, in my videos, I'm giving you tips on how to maneuver through all the hardships of investing, compound interest, dividend portfolios, investing portfolios. I'm giving you advice on how to tackle uh, just this wild either bull markets or either any bear markets. So today's video, we're going to talk about compound interest. Why it's important, what is compound interest? I'm going to compare compound interest versus simple interest. What is the difference? Why? What is the big old interest in compound interest? I know, right? Tongue twister. Then also we're going to talk about we're going to go over the compound interest formula, the equation for individuals who already want to nerd out and just want to learn about that. We'll go through a couple examples, and also lastly, going to show you how I take advantage of compound interest to ultimately encourage you to either start and develop a investing strategy to begin to start investing into either your own index funds or ETFs, or to start a dividend portfolio. So if you haven't so far, like and subscribe to my channel. On right here to the right side, it's going to be a red button. Click the red button to subscribe to my channel. Watch the whole video all the way through to learn about compound interest. And here we go. Wingman to go. Here we go. So how does compound interest work? Compound interest is calculated by multiplying the initial principal amount by 1 plus the annual interest rate raised to the number of compound periods. Most importantly, what is compound interest? Compound interest is interest on top of interest on top of interest. Compound interest is when you have a certain amount, $40,000, let's say for example, you times it by whatever the percentage is, and basically whatever the interest that you receive from that particular amount, you add it to the original amount, and then the next go round is going to increase by the new base. So that's basically what compound interest is in a nutshell. And here is an example of compound interest being calculated. And this is right here is a graph to show you why. And I'm going to more detail of compound interest and why it's very big and why it's important. So compound interest calculator. The compound interest formula is basically interest on interest. Compound interest is interest on interest. Take a base, times it by interest, add it to the base. Take the new base, times the interest, add it to the new base, and then it grows, and then it grows. That's why it's essentially interest on interest, or the ability for the financial instrument to generate earnings on its earnings. The compound interest can be calculated by using the formula FV, which is future value, equals P times 1 plus R divided by N raised parentheses to N times T parentheses. Now, what are you wonder, like, what are these alphabets? I ain't come here to learn the alphabet or these strange language. Let me go into detail. So FV is future value of a loan, or let's say the investment that you want to the end amount, equals P. P is the initial amount. So let's say the future value is I want to make $100,000. I want to make $200,000, equals P, your initial amount. Usually in diagrams, the initial amount is $10,000. So take that $10,000 or the initial amount times 1 plus R. R is the annual interest rate. So typically the interest rate of certain things, let's say like a dividend stock or whatnot, let's say 3%. So whatever the initial amount times 1 plus that interest rate. N represents as many times it's compounded. So your investment can be compounded annually, just like if you invest into dividend stocks, some dividend stocks can be compounded quarterly, monthly, and so N represents just the time periods of your compounding periods, and then T is just your time frame. It usually is in years. So if you want to initially invest $10,000, whatever the interest rate of whatever you're investing in, then you take into the compounding periods, right? If it's compounding on an annualized basis, quarterly or monthly, and then basically time. And then right here it goes through an example, but basically that is in a nutshell, the compound interest formula. Future value equals P times parentheses 1 plus R divided by N raised to N times T, which again, FV is future value. R is the interest rate of whatever you invest into, either your dividend portfolio or particular stock that you invest into, and then T is just the time frame. That's all. The next thing we're going to talk about the difference between simple interest and compound interest. Simple interest is calculated annually on the amount that you deposit or what you owe. So basically, simple interest in a nutshell is you deposit $10,000. Simple interest is that with 5% at the end of the year, you want to go get 10,000 times that 5%. That's it. And then the next year, that same 10,000 is going to get times whatever 5%, whatever that amount is. That's all you're going to get. It's not added to the base. But compound interest is interest added to the principal, forming a new base on which the next round of interest is calculated. So a good example is take that 10,000 times by 5%, and I want to say that's $500, right? That $500 is added to the 10,000 at the end of the year. So then your new base or your new amount is 10,500. Then the next year, that 10,500 times 5%, whatever that amount is, it's going to be it's going to be a new amount added to the 10,500, and you see how in the beginning it slowly grows, and that's why it's compounding. That's why compound interest start off slow in the beginning, but it goes parabolic. Compared to simple interest, you just have your just initial amount times it by whatever rate, and that's all you're going to get. And at the bottom right here, here's an example. If you take that same just regular $10,000 investment with an interest rate of 10%, and then the compounding periods of in regards to so as you see with this simple versus compound interest calculator, if you just have just all variables equal, a starting balance of $10,000 with an interest rate of 10%. I chose 20 years as the time frame. I chose 20 years as the time frame for both examples. And then as you see, with simple interest, is very linear. Simple interest is the gray on the graph, and the compound interest is the blue. So you see, it starts out small, where 10,000 times 10%, add on to 10%, add on to 10,000, starts off small, and then eventually goes parabolic. That's why everybody loved the whole concept of compound interest versus simple interest. So just wanted to show you guys a quick example on a graph of simple interest versus compound interest. Now let me go over and show you some ways you can make compound interest in your daily life. Most importantly, how to build a compounding dividend portfolio for a lifetime for rising income. This is very important. There are many different ways you can participate in compound interest. One is if you buy ETFs or index funds, dollar cost average, whatever ETF or index fund you choose per monthly basis, let it increase, and then your portfolio balance will increase over time. Another way is what I like to do, what I like to participate in, this is compounding dividends. So with compounding interest, the most important lesson or rule that you have to understand is the rule of 72. So I have my calculator. So rule 72 just states that whatever you invest into, depending on the rate of return that you get, you take 72 divided by that rate of return, and that's how long your investment will double. For example, if you were to invest into Tesla over the last 5 years have given individuals roughly 50%, or on the high end about 67% increase. Even it has even doubled. So let's just say that Tesla, if you invest in just the stock of Tesla gives roughly a rate of return of 50%. That means that you invest into Tesla, your money would double within a year and a half. That's crazy. So imagine if you just one point in time, deposit one time $10,000 and just let your in a 10-year span having your money double every year and a half. That's crazy. That is crazy. Here's a chart to show why individuals invest into dividend growth funds and dividend growth stocks. Just by itself in the market, it shows that those who invest into dividend growth and dividend growth initiators, on average, it's lower risk, and then they tend to, between the year of 1972 and 2014, typically get an average rate of return of roughly 10%. You understand that it's the average. So even in the market right now, last year when the market was down over 20%, I actually was able to increase, and my portfolio grew 3%. That's because a lot of the growth stocks, like Apple, I want to say Amazon, Tesla, Google took a big hit, and so they take their money and they reinvest themselves into their own company. So in a great economy, in a bull run, the investment's going to increase because they, instead of giving the money into the shareholder, which is us, in form of dividend, they keep it. So by them keeping it, they improve on their company. The value of their company grows, and by you investing in that company, with your shares that you have grow. So then you can sell it at a later date. But companies like Johnson and Johnson and Procter and Gamble and Exxon Mobil, they just have a huge flux of cash. So they choose to give it to us as shareholders. And when you reinvest in itself in a down market, like what you see right now, even if the share price, if you bought it at $100 per share and it goes down to $80 per share, by just them paying a dividend alone, you're buying more of those shares at a lower price, so that when the market goes back up again, your share price appreciation skyrockets. How you make money with dividend investing. And right here's just a set of group of stocks individuals invest into. They're called the Dividend Aristocrats. The Dividend Aristocrats have increased their dividends for more than 25 years. So they're very reliable. Clorox, Target, PepsiCo, Chevron, ExxonMobil. I gave you an example about ExxonMobil, and I didn't even look at this. It's crazy. McDonald's, even in the down market right now in a recession, people go to McDonald's to get the dollar cheeseburgers. Well, because of inflation, it's not really dollar anymore. But McNuggets and sweet sour sauce and the nice warm and toasty fries. And so this shows the image shows the outperformance of the Dividend Aristocrats over the S&P 500. Now we know that just investing to the S&P 500 by itself is great because all of the growth stocks. But then this shows that Dividend Aristocrats are stable, they grow, they make a lot of money, and even in down markets like this, they pay that dividend and they grow their dividend. So how do you build a compounding dividend portfolio? It's all about diversification. They say that the best way to build a dividend portfolio is to have roughly 15 to 20 stocks. Me, I have about 35 stocks, and this is just right here just give you an example of a group of stocks that you can invest into. And right here, it just shows the whole rule right here to diversify your portfolio. So you see right here, this portfolio is pretty balanced. These dividends are the dividend aristocrats have increased their dividends for more than 25 years, so you know they're reliable. And then also more than likely, you keep investing into this, and then you can use your portfolio into retirement, and then basically you have roughly 20 to 25 stocks that pays you just like paychecks. Now, compound interest and with dividend investing, the power of compound interest, just wanted to show you just a quick example. I went over how to start a dividend portfolio and the impact with compound interest with dividends. Also, just wanted to show you that this is my portfolio. My portfolio has a 3.41% dividend yield. Uh, so if you were to buy my portfolio, all the stocks in my portfolio right now, you would be averaging right around 3.41%. But because I've had my portfolio for 5+ years, I'm really yielding on cost, yielding 3.81%. And for the month of January, I'm going to be making roughly $88, and my annual income is $1,429. So I have a lot of dividend aristocrats in my portfolio, like AbbVie, Coca-Cola. I have some shares of Microsoft and McDonald's. I have some shares of T. Rowe Price, UPS, just several stocks that's very familiar to a lot of investors. And in my last example, I want to show you how my portfolio, my $41,533 portfolio, how by me investing on a per monthly basis, how my portfolio is going to grow, and on average, produce and make me roughly over $50,000 in annual dividend income. So let's go over this example. So overall, let's tie it in. We talked about what is compound interest, how it affects you. We talked about how to create a dividend portfolio with compound interest, and then now we're going to show you an example of a dividend calculator. So I put in all my metrics for my dividend portfolio of 41,500. My dividend portfolio has a yield of 3.5%. It produces annual increases, dividend increases of 11%, and then a stock price appreciation of about 10%. And also, I plan on investing at least $10,000 per year into my dividend portfolio. And as you see right here, starting out this year, by me being only 33 years old, even if you add just 10 years, of me just stay consistently investing into my dividend portfolio, after 10 years, I'll have a portfolio balance of over 280,000, and my portfolio will be producing $10,000. So that'll be $10,000 of passive income that I didn't have to do anything. That of it growing, reinvesting itself, and this is just the dividend snowball, just in working in real time, and then just additional five years of me investing and reinvesting itself. I was once be making 10,000, and then 15 years from later, I'll be making 23,000. That's 23,000 of dividend income passively. And I show you examples through charts how compound interest start out small and it grows, and then right here it shows that it really does start out small, and then once you hit 100,000, then it begins to pick up speed, because then that portfolio balance of 100,000 times 5% added on to a six-digit portfolio really hits the ground running. And so then lastly, after investing for 20 years, I can really envision to see a portfolio of over $1 million, and for it to be producing over $40,000 in passive income. Then I can just live off of it, and ultimately I'll move out the country to Panama. Colombia, Bangkok, Thailand, because I traveled there. I like it there. Or probably London somewhere, somewhere little bit cheaper than the United States, but at the same time, I'll come back to visit the United States. So once again, welcome to my channel. I'm glad you hope you enjoyed learning about compound interest. Hopefully you enjoyed learning about how to make a dividend portfolio and maximize your compound interest. Like and subscribe my channel. Click the button to learn more about my channel, about finances, luxury lifestyle, how to invest, how to beat the market, and how to put yourself in the best position to make more money passively. All right. Thanks for subscribing. Thanks for looking at my video.